Welcome to the Money Metals Midweek Memo, news and commentary relating to sound money, the precious metals markets, and the economy. I'm your host, Mike Maharrey. Thanks for tuning in. Well, they say there is a time for everything. And for the first time last week, we saw $3,000 gold. It's a pretty significant milestone, but when you step back, you realize that this is just one of the many bits of new ground gold has broken over the last 18 months or so. Since the end of 2023, gold has climbed to $3,000 from $2,064 an ounce. That's a 45.3% increase. The yellow metal is up over 14% in 2025 alone. Along the way, the price of gold hit new highs 40 times in 2024, and this year, the yellow metal has already broken 14 new records. In fact, I think that number is outdated because this morning we were already at 3,050. And, it's not just that gold has broken through that $3,000 resistance. It's how quickly it has happened. Gold's meteoric rise is actually unprecedented. It drove from $2,500 an ounce to $3,000 an ounce in just 210 days. To put that into some historical context, gold has taken an average of 1,700 days to reach each of its previous $500 milestones. So for over 1,500 days to get from 500 to 1,000, 1,000 to 1,500, and we did this in just over 200 days. Now, to be fair, each $500 price gain does represent a smaller percentage increase, right? So the price had to double to move from $500 to $1,000, while the most recent surge from $2,500 to $3,000 was a 20% gain. Still, 210 days, very, very fast move up. 20% in 210 days. That is a pretty impressive bull run. And consider some other context here. The price of gold has increased sixfold since it first hit $500 an ounce. That was in 2005, so it wasn't that long ago. Certainly within everybody's listening's, kind of recent memory, that we had $500 an ounce gold. If you look at the increase from 2005, it annualizes to a 9.7% yearly rise. So, if you average all of that out, gold is up 9.7% per year going back to 2005. Meanwhile, the S&P 500 spot index is up 8.2% during that same period. So as impressive as the rise of the stock market has been, especially recently, as much as we've seen the S&P 500 going up and up and up, gold has actually outperformed if you annualize it out since 2005. The speed of gold's rally is also reflected by the 200-day moving average. The recent surge in the price has pushed the gains 3 deviations above the 200 DMA. The last time we saw this kind of extreme divergence was during the pandemic, when gold crossed $2,000 an ounce, and then again right before the move to $2,500. Now, if you think about that, think about the significance of what was going on in the economy during the pandemic, which incidentally was 5 years ago this month that the whole world shut down. It's interesting to look back on that and realize how dumb some of that stuff was. But that's neither here nor there for this conversation. But the reality is, think about all that was going on. Governments were literally shutting their economies down, right? People were being forced to stay home. Nobody was buying anything. Nobody was producing anything. That's the last time that we saw this kind of move up in gold. What's going on now? Well, at least from the surface, nothing of that significance is going on. And in fact, up until a few weeks ago, we were told the economy was great, right? So this is an extremely significant moment, I think. We are seeing ripples in the undercarriage of the economy right now. And I think it's important as you look at this gold rally, as you kind of sit back, take a breath, look over the last 18 months, 2 years, since we've started to see this percolation. All of this is telling us that there is some type of shift going on. This is a significant moment in economic history. And what we're seeing, in my opinion, is we're beginning to see the ramifications of the unprecedented policies that were implemented during the COVID era coming to fruition. We're seeing the consequences of what I like to call monetary malfeasance. We'll get into that a little bit more as we kind of look at the reasons why we're seeing this gold bull rally at this point. I think another thing that's interesting, just kind of looking at, I don't know if you want to call it the technicals, but kind of looking at the trajectory of this gold rally. It's interesting that it only took 2 runs to apparently build support at $3,000 an ounce. So we hit $3,000 for the first time last Friday, and it did not initially maintain that level. It was midday trading that we saw that $3,000, and then it fell off a little bit. On Friday afternoon, the price had retreated to about $2,996 an ounce. So it didn't drop much, but it did not hold that $3,000 level. But on Monday, we saw gold eclipse $3,000 again, and this time it held. And yesterday, the yellow metal drove even higher. And this morning, when I first started preparing for this show, gold was trading at $3,050 an ounce, which is another, kind of a psychological level there. And again, surprising how quickly we drove from 3,000 to 3,050. I actually thought it was going to take several runs at 3,000, being such a significant resistance point. I thought it would take more to really clear that level. So we know that gold is up. It's exciting, especially if you're invested in precious metals. We've also seen a rally in silver, and actually the percentage rally in silver has been a little bit more than gold. It's kind of happening under the surface, but we have seen that gold-silver ratio drop below 90. It had been running above 90 for several weeks. And for those who aren't really savvy in what all of this means, well, the gold-silver ratio is basically just how many ounces of silver you can buy with 1 ounce of gold. And it tells us the historic relationship between gold and silver. And typically, that ratio historically in the modern time has run between 40 to 1 and 60 to 1. So when you start talking about 90 to 1, that's an extremely high ratio. It tells you that silver is undervalued compared to gold. And so all of that to say that silver's recent rally has actually closed that gap a little bit. And as I've talked about before on the show, when I've talked about silver, silver tends to follow gold in a gold bull rally, but it tends to lag. And when we really see gold or silver start to catch up is later in a gold bull run. In fact, historically, silver has outperformed gold in a gold bull run. So something to think about if you're wondering, oh, what do I do next? Silver is still really cheap on a relative basis. So that might be a play that you might want to think about if you're looking into getting into the world of precious metals. And I need to do a show on silver because today I'm going to focus mostly on gold. But keep in mind that fundamentally, silver is a monetary metal, and over time, it does tend to track with gold. So just keep that in mind as we go through the discussion on gold. So let's talk a little bit about what is driving this rally. And there are several underlying factors that I think are contributing to the gold bull market right now. And of course, if you listen to CNBC, Fox Business, the blossoming trade war is the dynamic that is most often cited as the catalyst for this gold rally by the mainstream media. Many analysts worry that increasing tariffs are going to drive up consumer prices, and that is going to drag down economic growth. And I think that is a valid concern. Trade wars do not bode well for the overall economy. And the other problem is we have a lot of regime uncertainty when it comes to the trade war. And that's because President Trump is prone to quickly shift policy, right? He'll announce tariffs one day. He'll say, no, we're going to wait a month the next day. No, we're going to do it today the next day. And this has created a significant level of uncertainty. And as Hargraves Lansdowne's head of research, Victor Hassler, pointed out in an article that I read, markets hate uncertainty. And she says this dynamic has helped to drive gold prices to a new high. So it's not just the trade war, it's not just the tariffs, but it's the market uncertainty that is being created by the way the trade war is being handled. And of course, we've talked about this before on the show. The tariff threat has contributed to a significant structural shift in the gold market, with tons of metal moving from London and also a lesser degree from Asia into New York. And I've talked about this before. I don't want to get really deep into this. I'll link to an article on the show notes page over at moneymetals.com/news that goes into some more details about why the tariff threat has created this situation where physical metal is moving from London to New York. But it basically has to do with future prices in New York rising higher on worries about tariffs, that might push prices higher. So it pushed the futures price in New York higher, and that created an arbitrage opportunity, and big banks, investors who could quickly move this metal were able to take advantage of that. So that's why one of the reasons, at least, we saw this shift. Now, there's some other even deeper underlying structural factors in the gold and silver market that others have gotten into on our website. Again, I'll link to an article in the show notes if you want to dig into that a little bit more. But this is part of what is driving the price of gold higher. So anyway, the trade war is really in the spotlight, but of course that is not the only factor that is driving gold higher. And Cosmos Currency Exchange founder Tony Redino told Yahoo Finance that though it feels like a psychological threshold, gold at $3,000 might just be a stepping stone if the trade war deepens. But then he says, that said, it's not all about Trump. Central banks, interest rate bets, geopolitical tensions, and inflation concerns are all stoking the flames. And I would argue that some of these factors are probably more deeply embedded than the trade war situation, because we have to go back. Think about this. This gold bull run is well over a year old, and the trade war is much younger than that. So what are some of these other factors? Well, now we have recession worries that have started to spring into the picture, which is interesting because, for months we heard the pundits and the politicians and everybody saying, oh, the economy's great. You remember soft landing. That was a very popular term, last year. We're going to have the soft landing. The Fed is guiding us in, right? We're going to have a lowering of inflation and the economy is going to be just fine. We were told that for months. Now, all of a sudden, the mainstream has gotten jittery about a potential recession. And we see this if you go to the Atlanta Fed's GDP Now forecast. Every week or so, the Atlanta Fed does a projection of how they see the GDP shaping up for the next quarter. And it plunged from a 2.3% growth rate in late February to a negative 2.8% shrinking growth or contracting economy. And this happened within like a matter of weeks. If you look at the chart, the line almost goes straight down. And again, mainstream analysts tend to blame the trade war for all of the sudden recession worries. And I think that is what has kind of brought it into the forefront of people's minds. But the economy has been poised for a downturn for well over a year. And if you're a regular listener to the show, you've heard me talk about this. Right? You've heard me talk about the underlying problems in the economy and that things weren't as good as the data crunchers would have you to believe. And, speaking of this not so strong economy, did you hear that Forever 21 is closing all of its stores? I mean, I guess it's true. Nothing is forever, right? And Forever 21 isn't drowning alone. Corporate bankruptcies reached a 14-year high last year. Now, think about that for a minute. Corporate bankruptcies, 14-year high last year. That means that corporate bankruptcies were higher last year than they were during the COVID years. Something to think about, right? And we've seen a lot of retailers struggle. Party City, Kohl's, JCPenney, Joann Fabrics have all filed bankruptcies in recent months. And then we have even some big retailers like Macy's. They haven't filed bankruptcy yet, but they are closing stores. So we've seen this contraction and this bubbling of problems in particularly the retail sector. And it's also impacting small businesses. Goldman Sachs' survey found that 91% of small business owners are struggling with the current economic impact on their industries. 91%. So it's virtually all of them that were in this survey. More than half, 56%, reported that the situation has worsened since the beginning of this year. Now, again, is some of this perception with the trade war? Possibly. But there have been structural problems, structural rot, as I like to call it, in the economy for a long time. And really, in my view, it comes down to the decades of easy money that we got in the wake of the 2008 financial crisis. This artificial easy money, artificially low interest rates, money printing through multiple rounds of quantitative easing. We saw this for 10 years. Rates held artificially low after the Great Recession and during the Great Recession. And then just as they were starting to try to normalize those interest rates, you go to 2018, 2019, the economy got shaky, and then they backed off of it. They never did unwind all of the inflation that was created during the Great Recession and in the aftermath. That never got wiped out. Now, Ben Bernanke promised that it would. I will never forget this quote. When he went before Congress, when the Fed had just started quantitative easing, its first big quantitative easing program in 2008, and he said, "This is not monetizing the debt. This is a temporary emergency measure." Temporary, right? And here we are in 2025. All of that, that money that was created in that time, all of the assets were added to the balance sheet back in 2008 are still there. And then, of course, we got to the pandemic and they doubled down in an unprecedented, faster than anybody imagined way. They pumped another almost $5 trillion into the economy. All of that money is still sloshing around out there, right? Now, we finally had to deal with the price inflation that these policies created, right? They tried to tell us, oh, this is transitory. And they tried to string us along for a while, but eventually they had to admit that they created an inflation problem. Well, they never admitted that they created the inflation problem. Let's be honest. They blamed it on supply chains and then later on Putin's price hikes and greedy corporations. But the fact of the matter is the price inflation got to the point that they could no longer ignore it. And remember, price inflation is a symptom of monetary inflation. So the central bank did what it had to do. It raised interest rates. It was forced to take the easy money drug away due to the price inflation. However, this economy is not built to operate in a normal interest rate environment. It is a drug addict. It is addicted to easy money. What happens when you take a drug addict's drug away? They get cranky, right? They go into withdrawals. There's problems. That's exactly what is happening today. And this is why the markets are so desperate for rate cuts right now. They want the easy money drug back. The drug addict wants his drug. And, you know, it's kind of a damned if you do, damned if you don't, because if you give a drug addict enough drugs, eventually it's going to overdose, right, and die. But if you take the drugs away, they could go into withdrawals that are so serious that they die. So it's not a good position that the Federal Reserve is in right now. An interesting article was published over by the Mises Wire by economist Mark Thornton, and I like Mark a lot. He's a really good economist, and he has a really good grasp on what is known as the Austrian business cycle, which is really just an explanation for the way these monetary interventions impact the economy. And he called the surge in business closures a sign of the times. Kind of a play on word, right? We have the closing sign. The closing sign is the sign of the times. And he emphasized that this is the inevitable consequence of central bank monetary malfeasance. He said it was not long ago when signs of help wanted seemed to be in every store window. That is starting to be replaced in 2024 and 2025 with store closing signs. This switcheroo tells us volumes about how people and the economy are adjusting to the Fed's money printing business. While the government and the wealthy elite benefit from the money printing, consumers and workers only seem to suffer. Absolutely true. I've talked about this before. This monetary policy is for the benefit of the government, right? This money printing, money creation allows the government to borrow and spend more than it otherwise could. It is the engine that drives big government, and it is at our expense. In effect, inflation is a tax that is levied on us every time we go to the grocery store or every time that we try to buy something. And Thornton argues that the shifts we see in the economy are reflecting the response of entrepreneurs and business people as they try to adjust to these monetary moves. Because keep in mind, nothing happens in a vacuum, right? The Federal Reserve can raise interest rates, or it can cut interest rates. It can do certain things. Well, entrepreneurs, people that are trying to maximize profits, that are trying to solve the problems of society, which is really what entrepreneurs do, they're going to adjust to the monetary moves. So Thornton writes, we know it is a Fed-caused business cycle. We know it is a Fed-caused business cycle because the trends happen in stages along with spikes in the data rather than in a normal fashion with no spikes in correlation. So large numbers of help wanted signs followed later by large numbers of store closure signs. The time of adjustment with business cycles is uncertain. We don't know exactly how much time will be involved or exactly how events will unfold. We do know that Trump's tariffs will make things worse, but not by how much. And I think this is a key point. We know that monetary policy is going to cause these problems. Artificially low interest rates cause malinvestments. It blows up debt bubbles. It creates all of these things. And then when you raise interest rates, when you take that easy money away artificially, then you have to unwind those problems that you created. But it is impossible to know exactly where the problems will manifest or how long it will take. We go back to 2008, and in that time, the easy money that was injected into the economy after the dot-com bubble burst, that tended to go into housing and real estate. So we had this massive real estate bubble, and we had the whole subprime crisis. And it's interesting to go back to that time period and note that things were shaky in the U.S. economy as early as late 2006, and it took nearly 2 years before we finally felt the impact of that monetary malfeasance. The monetary malfeasance that we had in the wake of the dot-com bubble bursting. Now, of course, the monetary malfeasance that we have now is like exponentially bigger than that. But here we are. Thornton wrote, the ways in which people have been adapting are particularly illuminating to the cause of the cycle, the Fed's money supply expansion, but also to the fact that it causes not just higher prices, but that it does cause a cyclical disturbance and that it creates winners and losers, and that above all, paper money is not neutral. That's why we need sound money. Because if we had sound money, gold and silver, you can't just create it out of thin air. That puts a cap on all of this stuff. We don't have that cap at all. And so you can have, a crisis that requires the injection of $5 trillion into the economy. But what kind of fool thinks you're going to do that and it's not going to have ramifications? Of course it is. And I think a lot of people are under the illusion that, the problem has already passed. We got a little bit of inflation. No, we have all of these malinvestments. We have all of this debt. At some point, those bubbles have to burst. Now, right now, the markets are clamoring for deeper rate cuts. We have a Federal Reserve Open Market Committee meeting that's going on right now. And by this afternoon, we'll have another statement from the Fed. We'll have some more hints on the trajectory of rate policy. And everybody's going to be looking and hoping and listening to Jerome Powell and hoping, I pray that he gives us some sign that we might get some rate cuts sooner rather than later. they think that's going to save us from the recession, right? We can stave this off. We can still have the soft landing. And, more of the easy money drug might kick the can down the road a little further. I mean, of course, that's going to mean more inflation, but eventually they're going to run out of road, right? We enjoyed a long, easy money boom. Booms always come with a bust, and the bust is generally commensurate with the boom. So if you have a big boom, you're probably going to have a big bust. And I really can't emphasize this enough. The reality is the malinvestments and the debt bubbles that were incentivized by these decades of easy money have to unwind eventually. And while we have dealt with the surge of price inflation, as I've already mentioned, due to the rapid infusion of money into the economy during the pandemic, we still haven't reckoned with the economic rot caused by well over a decade of easy money. We're still facing problems that were caused by the monetary malfeasance in the wake of 2008. All of that has to come undone at some point. I like this analogy. I've used it before on the show. The economy is basically like a dry grassland or maybe a forest during a drought, right? All you need is a spark and you end up with this huge fire. The trade war might be the spark, but those other things have caused that dry, drought-ridden landscape that is so ripe for a fire. Now, some analysts will tell you that a recession would probably slow down gold's rise. And one analyst that I read explained that during economic downturns, investors often sell gold to raise capital to cover their equity losses. So if you have a big drop in the stock market, people will sell gold because it is liquid and they can sell it quickly, and they'll use that to cover losses that they're having. And this is true. We often see a big dip in gold prices in the early days of a recession. But you can't just stop there. You have to factor in the monetary policy side. What will the Fed do if the economy tanks? Well, we saw what they'll do during the pandemic. They're going to double down on the easy money. That's the fork they know, right? 2008, the pandemic. What did the Fed people do? They slashed interest rates to zero, and then they launched multiple rounds of quantitative easing. And again, going to kind of the drug dealer, drug addict analogy, when you have somebody who's on drugs, it takes more and more of the drug to get the effect, right? You need more drug to get high. That's how you end up with overdoses. And, we go back to 2008 and we see the level of monetary malfeasance. We had rates at zero. We had 4 rounds of quantitative easing, and it, roughly $3 to $4 trillion injected into the economy. Then when we got to the pandemic, well, they had to do even more, right? Immediately took rates to zero and ran quantitative easing at a pace that just, made 2008 look like they weren't doing anything. So what will it take in the next downturn if they're really going to try to rescue it with easy money? How much more are they going to have to pump into the economy? How much more inflation are they going to create? And, this goes back to something that I've been talking about for at least 6 weeks, maybe a couple of months. The Federal Reserve is in a catch-22. And, given the escalating inflationary pressures, this February CPI notwithstanding, it was a little bit better, but still not great, right? CPI is still far above the targets. So it really needs to hold rates steady, or arguably even push rates higher to really get the price inflation under control. I mean, after all, I've been arguing for a long time it never did do enough to slay the inflation monster to begin with. And you could go back. Paul Volcker, right? Early 1980s. Massive inflation problem. What did Volcker do? He jacked interest rates up to 20%. We have rates, at 5.5 at the max when the Fed finally decided they'd done enough. And, I will grant you that 1980 is not the same as 2024, 2025. But the reality is the scope of the inflation fight was far greater, far more intentional back in 1980 with Paul Volcker than it was most recently under Jerome Powell. And I argued that they haven't done enough. They haven't done enough on the interest rate front, and they haven't shrank the balance sheet nearly enough. And I've talked about this before. You know, their plan to shrink the balance sheet, it would have taken 7+ years to just get the money out of the system that they put in during the pandemic, not even touching, the 2008 money that Ben Bernanke promised was temporary. So the bottom line is the inflation dragon isn't dead. I mean, sure, the Fed might have knocked it to the mat, but it's not down for the count. And this is bullish for gold. Gold is an inflation hedge. So if you have an inflationary environment, it's bullish for gold. I mean, really, when you get down to brass tacks, the increase in the price of gold is as much a decrease in the value of the dollar as it is anything else, right? The dollar is devaluing, and that makes gold more expensive. But then we have the other side of the equation. We have a central bank that needs to cut interest rates because the economy is addicted to easy money, right? We have these huge debt bubbles in the economy. We have a large amount of malinvestment and distortions in the economy. And the economy cannot function in this higher interest rate environment. It needs its easy money drug. And this is also bullish for gold. So I've already hinted at this, but I think the inflation issue is another bullish factor for the yellow metal. And as I already mentioned, the February CPI data did give markets a glimmer of hope. They were better than expected, and they showed some cooling, but we've seen this song and dance before. And as I said, price inflation remains well above the mythical 2% Federal Reserve target. Core inflation is still 3%, and it's been in that range for nearly a year now. So we've been mired in this kind of low-level high inflation, right? And it's important to note, and I've said this over and over again, any victory over price inflation sets the stage for the central bank to create more inflation. And I really think that's the core of the inflation story. It's not really the CPI. It's what's the Fed going to do. And what the Fed is going to do is it's going to return as quickly as it can to easy money. Now, it's going to try to walk that tightrope. It's going to try to, do enough easy money to keep the economy going, keep it high, so to speak. But it's also going to try to, not get that price inflation level again to the point that we notice it. And that's important to remember, right? Inflation is a policy. It's not an accident. It's not something that they think is bad. They want price inflation, right? The target is 2%. They literally want your money to devalue by 10% every 5 years. That's the plan, right? So when they say, well, we've beaten inflation, no, they've never beat it. They've just made it so that it's tolerable for you, and that's the whole point. That's the plan. They would take as much inflation as they could get if you didn't complain about it. So any victory over price inflation sets the stage for more inflation. And, rate cuts encourage borrowing. That's the whole point. We want interest rate cuts because the higher interest rates are putting a cap on the credit market. It makes it harder for people to borrow. When it's harder to borrow, it's harder to spend. And when you have a GDP that is primarily boosted by consumers spending money, well, they need to be able to borrow. We need the government to be able to borrow. Corporations have to be able to borrow. Our entire economy is run on debt. So high interest rates, not good, right? So when you have rate cuts, well, that encourages the borrowing. That incentivizes more borrowing. It stimulates the economy. But in turn, it boosts the money supply. And this is, by definition, inflation, right? An increase in money and credit is monetary inflation. A symptom of this monetary inflation is rising consumer prices, among other things. I mean, we see inflation manifest in the stock market, right? A lot of this stock market bubble has been fueled by easy money creation. We see it in other assets, real estate. Sometimes you see it in art. But prices rise due to this monetary inflation. And consumer price inflation, something that we all hate and hurts us, that's one of the symptoms. So in other words, Any victory over price inflation opens the door for the Fed to resume the very policy that gave us higher price inflation to begin with. So victory is defeat. I call the Fed's position on inflation surrender, right? They're not winning. They're going to surrender to inflation and just let it go because they're more worried about keeping the easy money drug in the economy so that the economy can keep going. And, there honestly doesn't seem to be a lot of mainstream worry about a resurgence of price inflation, but savvy gold investors, I think, recognize the fundamentals and are behaving accordingly. I think there is more inflation hedge buying out there than you might realize, but it's only a small handful of people that really understand the dynamics of monetary policy. The government has done a really good job in its PR campaign to muddy the waters to the point that people don't understand that it's the government and the Federal Reserve that's causing the price inflation. Again, they think it's greedy corporations or Putin or, voodoo or whatever. It is not. It is the Federal Reserve. It is the central bank. It is the government. They are the ones that are giving you the price inflation, and they're going to give you more of it. A spokesperson for the World Gold Council, I think, summed it up really well. They said, with rising inflation expectations, lower interest rates, and continued uncertainty, we continue to see support for gold looking ahead. Another factor that has been big in this gold bull run has been central bank gold buying. And of course, we've talked about this quite a bit on the show. Central banks have increased gold reserves by over 1,000 tons for 3 straight years. And keep in mind, this is official central bank gold buying. There's plenty of evidence out there that China, for instance, is hoarding a lot more gold than they officially tell us. But just going by the official numbers, we've seen this huge surge in central bank gold buying. To put it into perspective, central bank gold reserves increased by an average of just 473 tons annually between 2010 and 2021. So over the last 3 years, we have seen central bank gold buying more than double. Analyst Adrian Day said there is no reason to think that $3,000 gold is going to slow this institutional demand because there are other factors that are driving it. I think the two main ones are there are concerns about the United States' fiscal trajectory. They're looking at this $37 trillion national debt. They're looking at, $200-300 billion a month budget deficits. They're looking at a Congress who cannot get itself to face the spending problem, right? They're going to keep spending money, even as we have, Doge going on over here. We've got Congress saying, no, we're just going to fund everything, right? So there's this fiscal worry. I think people are worried about the dollar. Why hold something that is getting increasingly shaky? And then, of course, we have the de-dollarization because the U.S. has used the dollar as a foreign policy hammer. And people are saying, other countries are saying, hey, if the U.S. is going to use our dollars against us as a billy club, well, then maybe we should get rid of the dollars, right? Throw the billy club out so it can't be used to clock us on the head. And so we're seeing this de-dollarization. We're seeing many central banks increasing gold reserves, and we see dollar reserves falling. And I talked about this in depth last week, so I won't delve into it very deeply. But the fact of the matter is, there is every reason to believe that this central bank gold buying that is helping, basically put fundamental support in the gold market, that looks set to continue into at least the near future. As Adrian Day wrote, strong central bank buying continues and gold will move above $3,000. That round number is not a barrier for foreign central banks or indeed foreign buyers who price gold in their own currencies. So while this is a very significant milestone, $3,000 gold, very exciting, right? It's likely just one more touchstone in a long-term gold bull market. And, I've talked to several people over the last several weeks and months. I think believe that we are in a secular bull market for gold that's going to be long-term, long-running. And of course, you're going to see ups and downs, right? You're going to see the price drop. You're going to see the price rise. But a lot of people believe that we are in a secular bull market that is going to last for quite a while down the road. as we're looking at this run up to $3,000 gold, I've been kind of following what other analysts and folks have said. And it's interesting to kind of get this mainstream perspective as well. Barchart.com senior analyst Darren Newsom said that gold is currently moving up on its own momentum. He said, neither fundamental nor technical analysis matters at this point. Gold is the safe haven market at a time when global economies and politics are in a state of intentional upheaval. This is the safest way I can describe the situation at this time. Walsh Trading co-director Sean Lusk, he told Kitco News that everything seems to be pointing in gold's favor. Quote, you've got the central bank supporting it on any kind of sizable dips, increasing their holdings all across the world. On top of that fact, you have the geopolitical concerns that were real. Now you have a trade war. It's inspiring no confidence in equities for the near term here. And so a lot of bullishness out there, even in the mainstream. And we're seeing a lot of the big banks raising their gold forecast for 2025. Of course, they have to, because a lot of them, it was $3,000. And here we are in early March, and we're already, or I guess mid-March now, but we're already at that $3,000 mark. Now, word of caution. We may see some profit taking in the near term. Forex.com's James Stanley told Kitco News that he thinks $3,000 will bring some sellers into the market. But he emphasized, I am only looking for pullbacks at this point rather than full-fledged reversals. And, I think it's interesting. It's pretty significant that we haven't seen that pullback yet. Like, it feels like gold is already consolidated at $3,000 an ounce. And as I mentioned on top of the show, I thought that we would see several runs to 3,000 before it really stuck. But that said, it still wouldn't be shocking to see some consolidation in the next weeks, to see some sell-off, to see some profit taking, especially given the speed by which gold overtook $3,000. Kind of like a sprinter. If you're running a sprint race, you need a little time to catch your breath before the next race. And, if you look at the historical trends, gold is held above previous multiples of $500 for an average of 9 days before pulling back and consolidating. So in other words, we got to $1,000, we got to $1,500, we got to $2,000. On average, gold has taken those levels and then had a pullback within the next couple of weeks. However, also looking at the historical trends, those periods of consolidation tend to be short-lived. And 4 out of the 5 times, gold has rebounded to recover those previous highs within a few days of the consolidation and sell-off. So again, just a word of caution. If you see gold really dip here in the next couple of weeks, don't be shocked. This is within what you would expect in a gold bull market, And there's an old saying in investing in any kind of bull market, it climbs a wall of worry, right? You get to a certain point and everybody kind of freaks out, and then it sells off, and then it goes up again. So it goes in fits and starts, right? It kind of lurches ahead. Ole Hansen, I kind of like some of his stuff. He seems to be a pretty solid analyst. He's the head of commodities over at the head of commodity strategy over at Saxo Bank. And he said he would not be surprised if gold prices tested initial support of $2,956 or even as low as $2,930 as investors take some profits at this key psychological level. However, he added that he views any dip in the market as a buying opportunity. And I tend to agree with them, right? On the other side of the coin, the World Gold Council pointed out that if gold holds $3,000 for the next couple of weeks, say, it would likely trigger additional buying from derivative contracts, and it may actually drive the price even higher. This is from the World Gold Council. Quote, for example, we estimate there is roughly $8 billion in net delta-adjusted notional in options contracts from U.S. gold ETFs that will expire Friday, March 21st. And then $16 billion in options on futures that expire on March 26th. While this may create a slingshot effect, it could also trigger some short-term profit taking. So just kind of an interesting technical bit there. But I want to reiterate, buying opportunities. When you see gold dip, these are opportunities to get in. It's not too late, right? Gold is going to keep going up over time because, again, fundamentally, it's reflecting the devaluation of the dollar. And I don't think that the government, the Federal Reserve, I don't think they're going to stop devaluing dollars anytime soon, right? That's what they do. That's the whole premise of our financial system. So it's always good to have gold. It's never too late. And when you see the dips, it's an opportunity to get in and buy, get more gold, and solidify your holdings. And again, don't forget silver. I mean, we still haven't seen silver crash through that $35 an ounce level, which I think is kind of the resistance at this point. When silver does blow past $35, I think you're going to see it run up pretty quickly and start challenging its all-time high, $50 an ounce. And, I think when that happens, it's going to happen quickly. And don't forget, silver tends to outperform gold in a gold bull market, but it also tends to lag gold in a gold bull market. So silver is still historically undervalued compared to gold, which means, in my view, that this is still a really good buying opportunity for silver before it really starts its run up. But again, gold as well. Watch for the buying opportunities. This is a great time to talk to a Money Metals precious metal specialist. Just call 800-800-1865. Talk to them today. You can ask them. They can answer your questions. How can precious metals fit into my investment portfolio? They can help you figure out what products will work for you. These guys and gals are fantastic. Take the opportunity to use them to get an education for yourself. But, if you don't want to talk on the phone, I get that. You can just go to moneymetals.com. You can talk to a precious metals specialist in chat. Or you don't have to talk to anybody if you don't want to. You can just buy gold and silver over at moneymetals.com, and you will find all of our products. We have safe shipping. We have storage opportunities. We have a fantastic kind of build your gold and silver portfolio over time with our monthly buying plan, which is a great deal. I misspoke last week. I said as little as $200 a month. That's not right. You can actually get into our monthly payment plan at $100 a month. So a great way to build your precious metals holdings just a month at a time, a little at a time. So check out all of that. And again, just call 800-800-1865 or visit moneymetals.com. So one other cool little bit of news I got this week about this show. Both of our precious metals show here at Money Metals were ranked the best precious metals podcast by one of the pod tracking companies. So that's kind of cool. So with that, we're going to call it a wrap for this episode of the Money Metals Midweek Memo. You can get more information on all of the things that I've talked about on the show and a lot more over at moneymetals.com/news. And if you want to get the latest news and information relating to gold and silver right in your inbox, make sure you sign up to get on our email list. Of course, you can subscribe to the Midweek Memo podcast on your favorite podcasting platform. And when you do, you'll also be able to tune into our Market Wrap podcast every Friday, where you'll get a quick overview of the week in precious metals, along with conversations between yours truly and interesting people from the world of gold, silver, economics, and investing. When you see these episodes, please like them, comment, and share. That helps boost the show, and we really appreciate that. And more than that, thank you so much for listening to the show. It means a lot to me that you take a little bit of time out of your day and spend it with me. Thank you again so much. I will be back here again next week, and I hope you have a fantastic rest of your week. Until then, so long.